In the previous video, we talked about the double bottom and double top patterns. In this video, we're going to talk about the next important pattern, the head and shoulders. The head and shoulders pattern begins with an uptrend where the price make a higher high. The head between two lower highs that makes the right and left shoulders. The low point between the two shoulders is called the neckline, which acts as a support level. From a price action standpoint, this pattern signals a loss of momentum from the buyers. The right shoulders form at a lower high, indicating that the buyers are struggling to push the price higher and a potential trend reversal is on the horizon. Now let's reverse this and look at the inverse head and shoulders patterns that forms in a downtrend. Here, the right and left shoulders form lower lows, while the head is a swing low between them. The swing highs between the shoulders create a resistance or a neckline. From a price action perspective, this pattern shows that the sellers are losing momentum. The right shoulders forms higher low, indicating that the seller pressure is fading and a trend change may be starting. And just like the regular head and shoulders, there is a higher quality version of the inverse head and shoulders with a slanted neckline. This means that a higher high has already been formed, making the neckline slanted. From a price action standpoint, this version provides stronger confirmation of a trend change because both a higher high and a higher low have occurred, showing a full develop reversal. So the question becomes, how can we use the head and shoulders pattern in our overall trading strategy? There are three key ways to trade a head and shoulders pattern. Let's start with the first one, the neckline break entry. Once the pattern is formed, you'll notice that the neckline is drawn based on two key points, the lows for the regular head and shoulders and the highs for the inverse head and shoulders. The key signal for entering the trade is when the price breaks through this neckline. For the regular head and shoulders, once the price breaks below the neckline and makes a lower low, it confirms a reversal and the trend change from bullish to bearish. This is when you take a short entry expecting the downward movement to continue. On the flip side, with an inverse head and shoulders, once the price breaks above the neckline and make a higher high, it confirms the reversal from bearish to bullish. And this is when you take a long entry as the uptrend is now confirmed. Now let's move on to the second variation of this strategy. Instead of taking the breakout entry right away after the neckline break, you can wait for a pullback. This means waiting for the price to retrace back to the neckline, which now acts as a support in the case of an inverse head and shoulders, or as resistance in the case of the regular pattern. This pullback entry can often offer a more secure point to enter the trade. Now let's explore the third variation. Typically, the traders wait for the head and shoulders pattern to fully form and take a trade once the neckline is broken. However, there is a more advanced strategy that involves taking an early aggressive entry right at the right shoulder of the pattern, allowing you to anticipate the trend change before the neckline break. Here is how it works. First, you identify the left shoulder followed by the head of the pattern. The key here is that the left shoulder already establishes a resistance level or support at the inverse pattern. Had the price moves back up at the resistance level, you start looking for candlestick patterns that indicate a reaction to the resistance level. Long wicks or other signs of price stalling, for instance. These candlesticks suggest that the price is struggling to break out through this level, setting up the right shoulder. Once you see this reaction, you zoom into a lower time frame to look for additional price action that signals a potential trend change, confirming the formation of the right shoulder. Let's say that you pull out the 1-minute time frame alongside the 5 minutes. On the 5-minute chart, you've identified the key resistance level where the right shoulder should form. Now, on the 1-minute chart, you see a descending triangle pattern forming right at the resistance level, adding further confirmation of a potential reversal when the price breaks below the descending triangle. This confirms the reversal from an uptrend to a downtrend and also completes the right shoulder of the head and shoulders pattern on the higher time frame. At this point, you'd enter a short trade, capitalizing on the confirmed trend change. In the next video, we are going to review the triangles, the wedges, and the channels.